The US dollar just had its worst week in over a decade. Bond yields are spiking, China is dumping US debt, and for the first time, people are seriously asking, is this the beginning of the end of the dollar dominance and a potential government insolvency? Well, that's exactly what we're going to cover on today's video, because if you hold cash, have a mortgage, or even invest in index funds, this is going to seriously impact you. If you're new around here, hi, my name's John of John's Finance Tips. This is a channel I dedicate to talking all things money, making, saving, and investing. And more importantly, I'm gonna share with you what I'm doing to make sure that I don't see too much red in the portfolio. If that sounds like a plan, pop a squat, tap the thumb icon, let's get into it. So here's what's happened. The US dollar has fallen to its lowest level in 11 months compared to other world currencies, and it's dropped nearly 3% in 2 weeks. And at the same time, treasury yields, aka the amount of interest that the government has to pay on its debt, briefly surged past 5%, which is a major no bueno. In the most alarming part, foreign investors, primarily Japan and China, have been selling off their US treasuries, aka their US debt, at some of the most alarming rates we've seen in recent years. Okay, so markets are down because of the Trump tariffs. Isn't that expected? Yes and no. Sure, things are going to sell off because of the Trump tariffs, but the way that this market is moving right now is not normal whatsoever. Here's the thing. When the stock market falls and the bond market falls at the same time, that's a huge warning sign that foreign investors may not be as confident as they were in the US government to pay back its debt. And keep in mind, this entire global financial order since the 1950s has run on the premise that America, kind of like House Lannister. And Lannisters
always pays his debts.
And so folks have always had the assurance that America is going to pay back their debt. And that's why they're willing to lend to us. However, if that were ever not the case anymore, which it seems as if that's the path we're going down, life as you and I know it, about to change big time. But before I walk you down the dollar Armageddon, let me take a step back so you understand what's so important about the bond market and bond yield and treasuries. So what exactly is a bond versus a treasury versus a yield? Quite simply, a bond is just an IOU. A treasury that you hear news outlets talking about is just a bond that the US government issues. They're pretty interchangeable terms. So you can think of a treasury bond like an IOU from the US government. When the government needs money, they sell these IOUs to investors and they promise to pay them back interest on that loan. So here's an example. Let's say you buy a $1,000 government bond with 3% interest. At the end of the day, you're gonna get back your $1,000 plus the 3% interest, or $30. And up until recently, investors have full faith in the US government to pay back their debt. And so they're gonna hang on to that IOU until it fully matures and they get back their initial money that they put in plus the interest. But what if you didn't have faith in the government to pay back that initial loan? Well, you can take your IOU and sell it to your friend at a discount, let's say for $600. So now this friend is still gonna be able to redeem that IOU for the initial interest payment of $30. However, $30 of interest divided by the price of $600 that they paid for the IOU, their effective yield or their effective interest rate is actually 5%. So you see how when the price of the bond drops from $1,000 to $600, the interest rate or the yield can go up. So now you'll be able to understand when the news outlets are saying about interest yields going up, but bond prices are going down. They're inversely related, meaning they work in opposite directions. And another way that you can think about it is, if someone doesn't trust your IOUs, the demand for those IOUs drop. But if you want people to buy your IOUs or lend you money, you have to give them more interest to bring them back in, and so yields will also have to increase. And this matters enormously for the US government, because unlike someone like me where I lend you $1,000 and pay you back $1,000, the US government has $35 trillion worth of IOUs outstanding. And much of this debt has to constantly be refinanced as those IOUs/bonds mature. And here's a critical point. When those yields or interest rates go up, the government has to pay higher interest on all of the new debt it issues, which that in and of itself isn't a huge problem in a vacuum if that was the only problem. But here's why rising interest rates plus a market crash is kind of like pouring gasoline on a fire. Normally, when the stock market here crashes, investors flee to a safer asset. And the safest asset has always been the debt the US government issues. Because remember, like Lannister, they always pay back their debt. And so when they want US government debt, aka treasuries, the demand goes up, and inversely, the interest rate or the yield will fall. This also makes it much cheaper for our government to borrow money. And this sort of safety mechanism has helped America avoid debt crises for decades. But right now, what we saw last week, right before Trump rolled back the tariffs, was the exact opposite. Stocks were crashing, and the demand for bonds were not increasing, they were also dropping, which means the interest rates were going up. This could have led to a potential global financial meltdown. You see, with rising interest rates, the US government could have at one point soon be spending well over $1 trillion a year just on interest payments, which is more than our entire defense budget. But of course, the government has to sustain itself and still pay for whatever is necessary, so they gotta go out and borrow more money. But now they're borrowing more money at a higher interest rate, and that debt becomes harder and harder to pay off because interest rates are rising. And this is exactly how some countries can become insolvent. They get trapped in this cycle of having to borrow more money to pay back existing debt. The interest rates are high on that existing debt. They need to borrow more money, and it goes on and on and on. And eventually, no one wants to lend to them. And if they do, it's at sky-high interest rates, which only makes the problem even worse. So then why is this happening now? It started with the Trump administration's aggressive tariff policy, but the root cause goes a bit deeper than that. For decades, America has been able to run a massive trade and budget deficit because the US dollar is the world reserve currency. This created what economists call an exorbitant privilege, where essentially the US government can just print dollars and the world will accept them. And why does the world just accept them? Well, global trade, international loans, and even most foreign central banks hold their reserves denominated in US dollars. In short, the US could kind of just continue spending beyond our means, and the world would continue lending us money and holding our currency. But foreign countries, including China, Japan, the EU, in recent weeks, have become a little bit more wary about our financial management. The US national debt has doubled in the past 15 years. The annual budget deficit is approaching nearly $2 trillion. And politically, the US is seen as incapable of making tough decisions about spending and taxes, and at the very minimum, committing to decisions that they've made. And so the tariff war is really just a tipping point that's accelerated something that's already been in motion in the background. It's just now, suddenly, as we said earlier, fuel on top of the fire. Foreign countries are more actively diversifying away from the US, fleeing to francs, fleeing to the euro, reducing the amount of US debt/treasuries that they hold, potentially, and there's been a lot of talk of this going on, establishing alternative payment systems that don't rely necessarily on the US dollar. And all of this would be a fundamental shift in the global financial order and really a vote of no confidence in the American financial system. And you might think that something like this is so rare. How could they do this? How could they try to debase the dollar, destabilize the dollar? We're, after all, the world reserve currency. Well, this isn't without historic context. In fact, this isn't even the first major currency to come under attack. Some context, back in 1992, the British pound collapsed when Scott Bessent, the current Trump administration Treasury Secretary, helped George Soros, yes, Soros, make his first $1 billion in a single day by betting against the British pound. At the time, the Bank of England had pegged the British pound to the German mark. But Britain's economy was too weak to support it, and Soros and Bessent saw an impossible decision that the Bank of England had to make. They could either keep defending the pound, burning through their reserves and crushing the economy with high interest rates, or they could let the pound decouple from the mark, face a bit of humiliation, and lose billions of dollars. And despite raising rates to nearly 15% on a single day and spending billions of dollars trying to protect the British pound, that day in '92, Black Wednesday occurred, the UK surrendered, allowed the pound to decouple from the mark, which meant it plummeted. Taxpayers in the UK lost billions, whereas on the other side, George Soros made his first $1 billion. And today, as a result of the tariff, China actually faces an exact same dilemma with the yuan. And this is all the result of the tariffs. China can either devalue the yuan, or they could defend it by selling US treasuries. And the first option of devaluing the yuan would make their exports cheaper to fight the tariffs that are currently ongoing. But the issue with devaluing their yuan is they might risk capital flight, meaning money in China, both from citizens as well as foreign investors or domestic investors, could leave. Second option, they can defend the yuan by selling their US treasuries. Second option is seemingly where they're headed right now, by selling US treasuries to shore up the yuan. But remember, when you sell US treasuries, What does that do? That increases interest rates of those treasuries. And what does that do to the US government? It makes it more expensive for us to borrow money. And remember that earlier spiral we talked about? Yeah. And so that's the irony. By pressuring China with tariffs and the global stage with tariffs, the US may have just accidentally triggered the very thing that threatens its global dominance. Then the critical difference between what happened with the British pound getting broken and the US dollar is that the US dollar is the world reserve currency. When Britain finally surrendered on its Black Wednesday moment, they hurt themselves, but really it was contained. If America faces its own Black Wednesday, well, let's just say 2008 would have looked like a cakewalk compared to this financial meltdown. So where do we go from here? Well, there's one path to potential US government insolvency that would look like something like this. First, foreign buyers are still spooked about the stability of our government, and so they continue to, one, not buy bonds, and two, sell bonds, which means the interest rate on bonds goes up. This would mean that it's now more expensive for the US government to pay back their debt, and the cost to borrow more money is also gonna be more expensive. Second, the higher government borrowing costs will spread throughout the economy. And in having no demand for long-term bonds, those long-term interest rates go up. So what that looks like is mortgage interest rates up, car loan interest rates up, credit card interest rates up. And what a lot of this could do is slow economic growth. It could completely dampen consumer confidence. You might see reductions in tax revenue, and this would all just make the government deficit all that much worse. Third, as the cost to pay back our debts starts going even higher and consuming more of the federal budget, you're gonna have political battles of how to tackle this. Well, the political battles are going to inject even more uncertainty for foreign investors because, man, why would we lend the US government money if they can't really figure out their money problems? And because foreign investors aren't gonna be confident to start buying US bonds, those interest rates up and up and up. And finally, we reach a tipping point where the dollar's reserve currency status becomes under threat as more foreign investors and foreign governments flee to currencies and bonds that are more secure and stable. Countries accelerate their move away from dollar-denominated trades, reducing demand for dollars and treasuries, and potentially triggering what would essentially be a self-reinforced spiral and crisis. Of course, this problem isn't gonna happen overnight, though the warning signs certainly are flashing red. And the question might no longer be if the dollar will lose its dominance over the global financial system, but now people might be asking when and how quickly and how disruptive is it gonna be for me, my investors, my business. But of course, that's just one potential path. The other potential path is, hey, we find some steady grounding here, everything stabilizes, and all of this is a big nothing burger. So then what exactly am I doing? I'm doing a couple things. First, I'm getting more exposure into international markets. Now, currently, if you guys know me, I'm an ETF index fund investor. However, admittedly, I have been completely overweight to the US market. Right now, I would say 85% of my portfolio is tilted into VTI or US stocks, and the rest is international. I'm gonna balance away from that to get more exposure into something like VXUS, which is basically everything excluding the US. That's not just because of this current situation. That's something, honestly, I should have just been doing all along, but all of this is certainly making me accelerate and diversify out of VTI into VXUS a little bit quicker. The second thing I'm doing is still looking at fixed income to have a cash reserve for emergencies. Let's say everything goes belly up. Well, I've got properties I still need to pay the mortgages of if they for some reason can't be filled with tenants. I have my living expenses, and so I'm putting 6 months in reserves, not just as cash, but into short-term government bonds as well as into a high-yield savings account. Which, by the way, if you don't have a high-yield savings account, get one immediately. It's literally like free money into your bank account every single month. And the third thing I'm looking at, tangible assets like real estate. Let's say we get into the situation currently right now with the tariffs where inflation goes up. One thing that's nice about real estate, it tends to keep pace with inflation because if the cost of everything goes up, well, wages hopefully are gonna go up as well to match some of the cost of living. And one component of cost of living are rents. And so rents would naturally go up. And so that's a good hedge against inflation. Again, looking at tangible assets. But the key for anyone watching this video right now is don't panic. Do not panic sell, do not panic buy. Think about what exactly your long-term goals are. Because another goal I do want to consider for us is that at some point, because my fiance is from Australia, we're probably going to spend some time living there and spending in Australian dollars. If the US dollar loses significant value against the Australian dollar, one thing I'm thinking about is, okay, how can I currency hedge that? Not as a Forex trade, but really, if I'm gonna be spending money in a different currency and I know maybe the current currency I have is going to lose value, should I consider moving some over? Again, that is very specific and unique to my situation, but the example is think about what exactly it is that you need to accomplish with your financial goals. So what I want to leave you with is just the fact that understand right now, we are living through probably one of the most significant global financial transformations potentially in our lifetime. I know millennials, we've had a lot of them, but this one truly could be that one. And the actions that you take today, tomorrow, next week could very well determine whether this transition becomes a financial catastrophe for you or an opportunity. And the key to all of it is figure out what are your long-term goals and how are you acting to get there, and to ignore a lot of the noise and a lot of the speculation that clearly is going on all over the markets. And as always, folks, this has been a great video. Let me know in the comment section down below. Do you think the government is headed for insolvency? Do you think the dollar is getting debased? Or really do you think this is completely overblown and we're gonna be back to stonks to the moon by next week? Let me know, and I will catch you all on the next video. Peace!